Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about ELGI equipments and whether you should buy the stock or not and what you should do in the coming few days. So, let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I start with analysis of ELGI equipment, here's a small request that kindly support me through Patreon, and once you do that, it will help me grow the channel here on YouTube, and once I have more than 100 patrons, I'll start with an education course on investment for no additional fee on YouTube. Plus, you'll get a number of articles as well as videos which are exclusively for Patreon members. So go ahead and have a look at that Patreon website and you'll like it for sure. Now about ELGI Equipments. The company was established in 1960 and they provide compressors for irrigation motors and farm equipment. So they are basically in the agricultural domain, and they have been in that for the last 50 years, 50, 60 years. It is a top brand in this segment. So basically they provide motors for water irrigation and for taking out water, groundwater, etc. And they are the leaders in that. They have a monopoly in this field, and across India they sell their products. Have operations in more than 18 countries worldwide as well, and they also produce railways and medical compressors. So it's not only irrigation materials, but they also provide railway compressors, etc., but to a lesser extent. The market cap of the company is around 1500 crores. If you look at the financials of the company, then the sales have dropped by around 1.3%. So the drop in sales has been quite enormous, not quite enormous, but still it has been a drop. And the EBITDA has fallen by around 42%. So that needs to be taken into consideration. The debt has reduced over the years, but the other income has tripled. So one needs to have an understanding that this other income is just probably is one off, and that won't come in on every quarter, and that might not triple every quarter or come at such an elevated level. So if you take that out and take that consideration out, the results have not been that great. Although the sales numbers tell me that their business is not affected so much because of the slowdown in the rural economy, or for instance, the rural economy has not slowed down that much, but after the current lockdown that has been initiated and extended, I'm sure the effect would be enormous on the company. The return on equity is around you'd say 13 and a half, 14%, and the operating profit margin is 9%, which is quite reasonable, not magnificent, but quite reasonable and not low either. The concern remains that the profit numbers is not that great, and it has fallen sharply and may end up falling more in this quarter and the next one as well because of the current macro condition that has been availing at the moment. If you look at the performance of the stock, then the stock is at a 9-year low at the moment, and the numbers have declined over the years. So numbers were pretty good in FY14 and 15, and that's from where the stock started to move up. And by 2017-18, it made a top, and then the stock has been declining, and the numbers have been declining sharply as well. The rural economy is slowly coming back, and that can be witnessed with the kind of numbers that have been shown by the tractors sales, that has been shown by other agri companies like UPL or Bayer Crop Sciences, etc. Crop protection products have been sold quite appreciably before this thing happened, which is the macro condition all across India. But before all this, till the December quarters, the numbers have been robust from the rural front. So it was expected that FY20 as well as 21 would be quite good. But now we could see a setback, and we could see a setback in all across the board, especially in the rural income. So return ratios have been mediocre, and probably the rural economy will take another 2 quarters to function, and that's why the stock has been in deep trouble at the moment. The promoter holding is extremely low, and that is also one deterrent why people do not want to get into such a stock. And it is trading at 21 times. So it is not that it is trading at say 10, 12, 15 times earnings, which most of the rural stocks are trading at the moment. So at 21 times, it feels like it is expensive, and probably in this run up to the downside that I expect over the next 2 3 months. This is one stock apart from other stocks that may fall another 15 20% going forward. So why I believe it is an avoid very low promoter holding is less than 40% at the moment, and that is a deterrent in itself. Although there are other companies in which promoter holding is less, in which I have said that those can become multi baggers, but in which in these companies we have seen numbers which are extremely robust, like doubling, tripling of sales and profitability. But here we are seeing that the numbers have not been that great, especially the top line has been pretty subdued. And if you look at the profit numbers, they are really declining fast. So in that respect, if the promoters are also not increasing stake at this point of time, that is a cause for concern. Rural economy will be hit in this pandemic and in this kind of trouble, and probably in the next 6 months we'll see uh, more, you can say, worse numbers going forward. And there are other companies that are coming at a discount, so it is not that only you would say that LG equipment which is going down and you can buy, but there are other rural centric companies. There are other companies in the consumption domain which have come 30 40% down from their peak, and coming at a discount in every field, in every sector. So there is a lot of choice that is around, so people might not look at something like LG equipments. And this recovery may take 2 or 3 quarters, so probably FY21 will go in recovery for this stock. And investors would like to see recovery and then get into the stock rather than getting into a stock and getting stuck. The valuations itself seems pretty expensive. So if you look at the FY21 numbers, on that I would say it is trading at 23 24 times earnings, which is extremely expensive compared to other kind of, you can say, agri equipment or agricultural companies. For instance, something like Bayer Crop Sciences is quite reasonably priced at the moment, and it is a far better company in terms of numbers, profitability, and track record than LG equipment. So one would like to get into that. Similar is the case with something like an Escorts, UPL, etc. So people would like to get into that. I'm just talking about only agri companies. There are other consumption and you can say urban centric companies which are even more at a discount. So better rural play as well as other kind of consumer centric plays that are available in the market at the moment. If you look at the technicals of the company, then there is strong support between 78 to 85 levels. So one needs to have an understanding that although these supports lie and these all technical levels are good, but when the market falls, then these technical levels have no value. So one has to take all this in with a pinch of salt. So 78 to 85 levels are very good levels to get into. The 200 DMA is around 245, so it is far off, and currently the stock is really at a distance. It is in a strong downtrend, and we may see levels closer to 60 65 going forward, looking at the current scenario and what lies ahead on the macro front in India. May fall below 100 soon and may go to 65 very easily. The long term stop loss can be maintained at 75 if you are holding the stock, but I feel if you're holding the stock and you're not making a lot of losses, then you need to get out of it. If you're holding the stock with a lot of losses, then probably you need to just hold on and let this pass by, and probably you'll get a better price to exit. There is surely a chance that we'll see further downtrend in the stock going forward. So the strategy in this stock would be that avoid for the time being. So in the coming weeks, if you have not bought into it, don't buy into it. Look at only top consumer brands, and I've talked about many brands a lot of times. And once you go on to my Patreon channel and you ask me questions there, I'll give you specific stock recommendation as to which one to buy. All these are all consumer centric stocks, be it in consumer discretionary or consumer staples. Only buy this only when economy picks up steam, and this goes at 6%, 7%. The economy really looks like that it would show a growth of 6.5% at least. If you're holding it, have a good 4 5 year view and you'll get your price. That is not to say that this economy will not come back and rural place will not work ever, but you should have some patience to get out of it. But in the next couple of years, I don't see much coming out of such stocks. Simpler businesses are coming at attractive levels, and this is one real deterrent that why people will not get into something like LG equipments, because there are simple businesses which sells car, which sell some products, some eating products, which are, or some restaurant joints, etc., recreation services, and other companies which are coming at major discounts, other consumer companies, plain consumer companies coming at discount, and people would look at such companies. And always have less than 5% exposure to any stock that you buy in the mid or small cap. So this was my video on LG equipments. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.